Welcome! First, we will challenge a common belief about 401k contribution limits and reveal how the real ceiling can be much higher than people think. We will walk through the two IRS limits, how they interact, and how the Mega Backdoor Roth can legally supercharge savings. Then we will cover examples, plan checklists, pitfalls, and a short quiz. Let's get started. Next, here is our roadmap. We will expose the myth, explain the two different IRS limits, demonstrate the Mega Backdoor Roth strategy, run practical 2025 math, list the exact plan features to look for, flag pitfalls, test your knowledge with quick quizzes, and finish with key takeaways and next steps. Now, let's expose the myth. Most people think the 401k limit stops at the employee elective deferral cap, which for 2025 is commonly cited as $23,500. However, that is only one of the two limits that matter. Focusing only on this number prevents many savers from unlocking a much larger legal contribution space. Moving on, here are the two distinct limits. First, the elective deferral limit under Section 402 controls how much you can contribute via payroll as either pre-tax or Roth deferrals. For 2025, we will use $23,500 for illustration. Second, there is a separate total annual additions limit under Section 415, which caps the sum of your elective deferrals, employer contributions like match or profit sharing, and employee after-tax contributions. For 2025, we will use $70,000 for illustration. Additionally, if you are age 50 or older, you may contribute catch-up contributions under Section 414V on top of the Section 415 cap. The crucial insight is that the space between the Section 402 limit and the Section 415 cap can be filled with employee after-tax contributions. Those after-tax dollars can then be converted to Roth, thereby creating tax-free growth potential in retirement. Furthermore, this mind map organizes the entire 401k contribution space. The root is overall 401k contributions. One branch shows elective deferrals under Section 402, which may be pre-tax or Roth and are capped independently. Another branch shows employer contributions such as match and profit sharing, which count toward the annual additions limit under Section 415. A third branch shows employee after-tax contributions, which can fill the gap between your elective deferral and the Section 415 cap. Finally, a separate branch highlights the catch-up contribution for those age 50 or older, which sits outside the Section 415 limit. The map also notes that after-tax dollars can be converted to a Roth 401k within the plan, or rolled to a Roth IRA if allowed, and that any earnings at the time of conversion are taxable. Now let's detail the Mega Backdoor Roth process. First, you contribute up to the Section 402 limit using pre-tax or Roth deferrals. Second, you continue by making employee after-tax contributions to fill the gap up to the Section 415 total limit, which includes employer contributions. Third, if your plan allows, you convert those after-tax dollars to Roth, either as an in-plan Roth conversion or by using an in-service rollover to a Roth IRA. Regarding taxes, your after-tax principal is not taxed again, but any earnings at the moment of conversion are taxable. Performing frequent or even automated conversions can minimize taxable earnings. The outcome is increased Roth balances, which may grow tax-free if withdrawal rules are met. Next, use this checklist with your Human Resources Department or Plan Record Keeper. Confirm that your plan allows employee after-tax contributions beyond the Section 402 limit, and that either in-plan Roth conversion or in-service rollovers to a Roth IRA are permitted. Ask about automatic sweeps that convert after-tax dollars to Roth frequently. Ensure the plan tracks after-tax contributions in a separate sub-account to isolate basis from earnings. Clarify whether employer matching applies to after-tax contributions. Understand any impact of ACP testing, particularly if you are a highly compensated employee. Finally, review conversion frequency, fees, and tax reporting requirements, such as Forms 1099-R. Meanwhile, let's compare the Mega Backdoor Roth and the Standard Backdoor IRA. The Mega Backdoor Roth leverages the 401k plan's after-tax contribution space up to the Section 415 limit, which can be tens of thousands of dollars, but it requires the plan to support after-tax contributions and Roth conversions. The backdoor IRA uses non-deductible IRA contributions followed by a Roth conversion, and is constrained by lower IRA contribution limits. It also demands attention to the pro rata rule across all IRA balances. If your employer plan lacks after-tax features, the backdoor IRA may still be a viable option. Now, let's quantify it. In Scenario A, a saver under 50 contributes $23,500 via Section 402 deferrals and receives $10,000 in employer match. That leaves $36,500 of room to reach the Section 415 total of $70,000 using employee after-tax contributions. The grand total remains $70,000 because catch-up does not apply. In Scenario B, a saver age 50 or older has the same Section 402 deferral and employer match, plus the same after-tax amount to reach the Section 415 cap. In addition, they may contribute a $7,500 catch-up on top of the Section 415 limit, yielding $77,500 in total potential additions. Always verify your actual employer match formula and plan rules. Additionally, keep these cautions in mind. After-tax contributions are not Roth until they are converted. Plans may be subject to ACP testing, which can limit or refund after-tax contributions for highly compensated employees. Earnings included in a conversion are taxable, so frequent conversions reduce tax exposure. If your plan does not allow in-plan Roth conversions, check whether in-service rollovers to a Roth IRA are permitted. Confirm that the plan tracks after-tax contributions in a separate sub-account to distinguish basis from earnings. Ask about fees and conversion sweep timing. Finally, adhere to withdrawal rules and the Roth 5-year clock to preserve tax advantages. Now for a quick check. The question is, which IRS limit caps all additions, including deferrals, employer contributions, and after-tax contributions, to the 401k for the year? Option A, Section 402. Option B, Section 415. Option C, Section 414 versus Option D, Section 125. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is Section 415. Section 415 sets the limit on total annual additions to a participant's account, including elective deferrals, employer contributions, and after-tax contributions. Next quiz. The question is, to run a Mega Backdoor Roth, which two plan features are most critical? Option A, after-tax contributions allowed and in-plan Roth conversion or in-service Roth rollover. Option B, employer match and company stock fund. Option C, brokerage window and target date fund. Option D, pension option and HSA. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is Option A. You need the ability to contribute after-tax dollars beyond the Section 402 limit and a mechanism to convert those after-tax amounts to Roth, either in-plan or through an in-service rollover to a Roth IRA. Now, visualize a pie chart of the Section 415 total at $70,000. The slices represent elective deferrals of $23,500, an employer match of $10,000, and the remaining $36,500 contributed as employee after-tax. This composition illustrates how the after-tax bucket fills the gap to reach the full annual additions limit. Before we wrap up, an important disclaimer. This content is for educational purposes only and does not constitute financial, tax, or legal advice. Contribution limits and rules can change, and plan features vary widely. Always confirm details with your plan administrator, review current IRS guidance, and consult a qualified professional who understands your specific situation. In summary, the commonly cited $23,500 figure is only the Section 402 deferral limit. The total annual additions limit under Section 415 can be much higher. For example, $70,000 in 2025. You can use employee after-tax contributions to fill the gap between the two and then convert to Roth for tax-free growth potential. Make sure your plan supports the required features. pay attention to testing constraints, fees, and conversion timing. If you are age 50 or older, remember that catch-up contributions sit on top of the Section 415 limit. Finally, thank you for watching. If this helped you see your 401k in a new light, please like the video, share it with someone who needs it, and subscribe for more evidence-based money strategies. I would love to hear your plan's features and your experience with after-tax and Roth conversions in the comments below.